Hey everybody, so in this video, I'm going to cover Snowflake and their Q4 earnings report. Now, I don't really know a whole lot about Snowflake, so what you're getting in this video is a pretty unbiased view on their financials. Also, this is going to be my first time looking at this company's financials. So what you're going to see here is going to be actual live reaction here. So first things first, I always like to scroll down, look for something that looks like an income statement. So right here, Snowflake condensed consolidated statement of operations. So these numbers are in thousands except per share data. So pretty much everything is in thousands except earnings per share is what that means. Now, if we're looking at the 3 months ended January 31st, right here we have the quarter for 2023 and the same quarter for 2022. So we're doing a comparison here. Now, we also have the 12 months data right here, 2023 and 2022. So let's go ahead and take a look at revenue. So revenue clearly increased. So here in 2022, we have about $383.7 million. Here in 2023, we have $589 million. So we could go ahead, we could run a calculation on that. So we could figure out what the year over year increase is. So to do that, I'm going to get the 589. 012, I'm going to subtract that by the 383, 774 equals, and then we're going to divide this number by the prior year. So the 383, 774, multiply that by 100 to get a percentage. So that's about 53.5% growth in revenue. So that's pretty good when it comes to revenue growth. That's actually very good. But here's the thing, we want to look at cost. So if we look at cost, cost is about 205.6 million. We want to see if this margin has changed at all. So if we're looking at the gross profit margin, what we're going to do is we're going to get the 355. We're going to divide that by the actual revenue. So the 589,012, we're going to multiply that by 100. All right, so that's about 65%. So yeah, 65% is their gross margin right there. Now we're going to do the same thing for 2022. So we're going to get to 249,594. We're going to divide that by 383,774 equals, times that by 100. So yeah, it's about 65% again. So gross margins have not changed a whole lot. Now here's what we want to pay attention to. This is the good part. So operating expenses. So we have sales and marketing, we have research and development, and we have general and admin. All together, this comes out to 623 million. So, yeah, that's not good. That's pretty stupid right there because look, their total operating expense is more than their revenue. And on top of that, they have cost of revenue too. So yeah, this company has a massive operating loss of $240 million this quarter. So yeah, that's not very good. Now, if you're looking at 2022, yeah, they had a little bit less. So, obviously from a GAAP standpoint, this doesn't look too great. Let's go ahead and calculate how much they're actually losing per dollar. So 239, 750, we're going to divide that by 589, 012. So essentially what this means is that for every $1 of revenue that they make, they are losing $1.40. So yeah, you make $1 and $1.40 goes out the door. That's essentially what that is saying. So let's go down the list. We have interest income. So obviously if you're going to have interest income, you're going to have cash stored away somewhere. So this does show a little bit of a bright light. It's basically saying, hey, you know what? They have investment income. Now, other income and expenses, yeah, this number is barely anything. But do note that in the prior year that this number was much higher. So, they do have expenses here. Let's see, net loss. So net loss, that's 207.5 million right there versus the last year's same quarter, 132 million, negative 132 million. And if we look at this bottom line right here, the diluted earnings per share, this is negative 64 cents per share. And right here, it's negative 43 cents per share. So if we're looking at the 12 months, we have negative $2.50 of earnings per share and negative $2.26 cents of earnings per share in the last year. So the EPS is going further down to the negative side. So that's never really a good sign. So right here, obviously if a company is losing money, you want to see, are they actually losing money? So that is when you start looking at the cash flow statement. Now, one more thing before we move on, a very important thing to look at is the shares outstanding. So right here in 2022, we had shares outstanding of 308 million. So 308.7 million. Here in 2023, we have about 322 million. So this number went up quite a bit. So that's never really a good sign because that means that investors are getting diluted. All right, so we're going to go ahead and look at their assets too. How strapped are they for cash? So if we're looking at cash and cash equivalents, right here they have about $939 million. So about $940 million right here. In the prior year, same quarter, they had a little bit over $1 billion. Now, short-term investments, this number has gone up. So that's probably why they have more interest income, because this number is going up right here. So they have about $3.68 billion here. And right here in the prior year, they had $2.76 billion. Also keep in mind that interest rates have gone up. So that also contributes to why their interest income was a little bit higher. Now, accounts receivable, this is about $715.8 million. Deferred commissions, current 68 billion. So or 68 million. So if we're adding up all of these very liquid assets right here, then that amounts to something very close to 5 billion here. So basically, their current assets have gone up. Now let's just scroll down a little bit. Long-term investments. This number has gone down a little bit. Goodwill. So let's see, goodwill. Oh, that number went up big time. So to me, when I see goodwill go up, goodwill really only goes up when you make acquisitions. So this company has clearly made an acquisition of some sort. So we're going to try and look for more of that information in the data. So intangible assets here, this number went up as well. Deferred commissions, that number is pretty much similar. So altogether, total assets went up pretty big. So it's about 7.7 billion now. In the last year, same quarter, it's about 6.6 billion. So obviously, a big contributor to this is that goodwill right there. Now, let's scroll down a little bit more. Current liabilities. So we have total current liabilities of about 2 billion. So much higher than the prior year, same quarter, where we had about 1.4 billion in current liabilities. So if we're looking at the total current liabilities to total current assets, the ratio, it's a pretty good ratio. I mean, it's more than 2 times assets versus actual current liabilities. So that's a good sign right there. It means that they're not necessarily in any danger of any bankruptcies or anything like that, because they could pay off their short-term obligations. So let's just scroll down a little bit more. Let's take a look at equity. So what is their equity account? Let's see. Other liabilities, total current assets. Let's see. Snowflake stockholders' equity. Okay, so that's about 5.5 billion right there. So what we can do is we could calculate book value per share. It's always a useful metric to look at. So we could do 5,456,436, and then we're going to divide that by the shares outstanding. So that's this amount right there. So divide that by 321,924 equals So the book value per share is about $17, and we're way above that. So do keep that in mind if this company ever just crashes to rock bottom. Keep this number in mind. Now let's go ahead and continue down. All right, so now this is the good part, the condensed consolidated statements of cash flows. Now these numbers are in thousands as well. So here's what happens. We get that net loss. Now this is calculated using generally accepted accounting principles, this net loss. So now what they're doing is that they're using cash-based accounting and they're reconciling everything to a cash basis, because things like depreciation and stock-based compensation are not cash expenses. So they add this back in so you know what the actual cash gain or cash loss is. That's why they call it a statement of cash flows, because you want to see, hey, do we have a cash outflow, or hey, do we have a cash inflow? So we have this $207.5 million loss, and we're going to start reconciling it. So to this, we're adding depreciation and amortization. We're adding non-cash operating lease costs. We're adding amortization of deferred commissions. And here's the big one, stock-based compensation. So we're adding a whopping $250.7 million back into this net loss. So that's going to make us go positive, because think about what stock-based compensation is. You're essentially rewarding your employees with stock instead of cash. So what this does is that it dilutes investors, but it saves the company money. So you could almost think of it as like an offering of sorts. So right here, we have more stuff going down the line. Let's see. If we keep going down the line, we see net cash provided by operating activities, $217 million. So here we go from negative $207.5 million, looking at a generally accepted accounting principles standpoint, to a $217.3 million, looking at a non-GAAP cash basis accounting right here. So also an interesting thing to note, it says right here, changes in operating assets and liabilities, net of effects of business combination. So this is basically saying that they had a business combination of some sort, so acquisition, and now they're showing this change in all of their assets and liabilities here. So that's further evidence that there was some sort of acquisition. So I don't necessarily need to know a whole lot about this company to actually get some sort of assumptions, because I can see all of those assumptions in the financial statements. Now, obviously, there are some more important stuff like what are they doing in their future operations that you want to pay attention to. But here we can see that net cash provided by operating activities is actually positive. So this company, I wouldn't necessarily say it's a zombie company, because they're actually making money. The only problem is that they're diluting you to do it. So that's never really a good thing. Hopefully, they could get to this position where, they make enough money that they're actually GAAP positive. Because when a company is GAAP positive, then you start seeing good things, because, then maybe they have enough money to do dividends. Maybe they have enough money to do buybacks. But as of now, they don't have that money. So they just keep diluting you through this stock-based compensation. So going up again, let's remind you how much that is. That stock-based compensation, that is $250.69 million. Now that is just for one quarter. Look at the 12 months end of January. So this is the entire year. So if you're looking at the entire year, this number is not that great. So for this entire year, $861.5 million went into stock-based compensation. So yeah, good Lord, that's a lot of dilution there. That's a lot of dilution. Alrighty, so let's keep going down. Let's see if we can find anything more interesting here. So purchase of property and equipment. Nothing unusual here. Now let's see, purchase of investments. So yeah, they've been making a lot of investments here, as you can see. Let's see. What else? What else? What else? What else? Keep going down. Proceeds from exercise stock options. Here you can see that they're exercising less stock options, as you can see, versus the prior quarter. Let's see, what else, what else, what else? Keep going down, keep going down. All right, so we're going to look at cash, cash equivalents, and restricted cash beginning of the period. That is about 835.8 million, and cash at the end of the period, 956.7 million. So yeah, their cash position increased. And why is that? Well, that's because they actually have an operating gain when you're looking at things from a cash basis. So right there, they actually made $217 million. But, you know, just another reminder, I'm going to kill this to death. They're only making this money because they're diluting the hell out of you and they're paying their employees through stock-based compensation. Now, let's just keep scrolling down a little bit, see if we could find anything else. Oh, okay, so here they do the GAAP to non-GAAP reconciliation. So this is the company's way of basically making everything look better than it actually is. So stock-based compensation is pretty interesting because you have to remember that there are employees in all aspects of the business. And this stock-based compensation isn't just one line item. It shows up in many, many different places. So, you know, let's just go through this reconciliation real quick. So right here, you know, when we're looking at cost of revenue, they subtract the stock-based compensation related charges. And they also subtract this amortization of acquired intangibles. So here we see stock-based compensation, and this is the first time we're seeing it right here. Now, we see it again. So right here, we see GAAP cost of professional services and other revenue. So now we see stock-based compensation again, another stock-based compensation line item. And then GAAP cost of revenue, less stock-based compensation related charges. So here we go. We see this again. And then we see it again right here, gross profit, add stock-based compensation related charges. So here you can see that this number is basically just this number right there, except they're adding it right here. So you can see stock-based compensation show up in all these different line items here because you have to remember the employees are all over the business. So the stock-based compensation is going to be divvied up in different areas of line items. So if you're looking at something like research and development, you know, it might be nested in research and development. It might be nested in cost of revenue. So it could be nested in all sorts of line items. So I do want to make that clear there. So hope you guys enjoyed this video and have a good one.